Something major just changed in the banking system, and most people have no idea even happened. While headlines focused on politics, wars, and interest rates, regulators quietly passed a new banking rule that officially goes into effect on Monday, and once it starts, banks will not operate the same way they did last week. This is not speculation, it is not theory, and it is not hype. This rule changes how banks measure risk, how they hold assets, how they treat government bonds, and ultimately how secure your money really is inside the system. If you have a bank account, a retirement plan, or even exposure to the stock market, this affects you whether you like it or not, because when the rules of banking change, the rules of money change with them. To understand why this rule matters, we need to zoom out for a moment and look at how the modern banking system actually works. Most people assume banks simply take deposits, lend money, and keep everything balanced. But in reality, banks operate on confidence, leverage, and accounting rules that allow them to hold far less cash than most people imagine. For decades, banks have relied on government bonds, especially U.S. Treasuries, as their safest asset. These bonds were treated as nearly risk-free, meaning banks could hold enormous amounts of them without setting aside much capital as protection. That system worked well when interest rates were falling or stable, because bond prices stayed high. But when interest rates rise quickly, as they have over the past few years, bond prices fall, and suddenly those safe assets become silent losses sitting on bank balance sheets. This is exactly what triggered the regional banking crisis that shocked markets not long ago. Banks were sitting on massive unrealized losses in long-term government bonds. These losses did not show up as long as the banks did not sell those bonds, but the moment depositors began withdrawing money, banks were forced to sell at a loss. Confidence vanished overnight. Regulators stepped in, emergency programs were created, and the public was told the system was sound. But behind closed doors, regulators knew the real problem was structural. The rules themselves were outdated for a high-rate world. That is where this new banking rule comes in. The rule that starts Monday is designed to change how banks account for risk and capital in a world where interest rates are no longer near zero. In simple terms, banks are now required to be more honest about potential losses and to hold stronger buffers against them. Assets that were once treated as nearly risk-free are now scrutinized more carefully. Long-term bonds, particularly those sensitive to interest rate swings, no longer get a free pass. This forces banks to either raise more capital, reduce risk, or change how they invest depositor money. For large banks, this is an adjustment. For smaller and mid-sized banks, it can be a serious challenge. Think of it like this. Imagine running a business where you were allowed to pretend certain losses did not exist, as long as you did not admit them. That was essentially how banks operated with long-term bonds. The new rule removes some of that flexibility. Losses do not disappear just because you close your eyes, and regulators are now demanding banks acknowledge that reality. This is why banks spent months lobbying against parts of this rule, warning that it could reduce lending and tighten financial conditions. Regulators push forward anyway because ignoring risk does not make it go away. It only delays the damage. What makes this especially important is the timing. This rule is not coming during a period of economic strength and low debt. It is arriving at a moment when government deficits are massive, interest rates are still high by historical standards, and debt issuance is accelerating. Governments are borrowing more, banks are absorbing more bonds, and markets are already sensitive to stress. Changing the rules in the middle of this environment is like adjusting the foundation of a building while people are still living inside it. Necessary, perhaps, but not without consequences. One of the most immediate impacts could be tighter credit. When banks are required to hold more capital, they often respond by lending less. That means fewer loans for businesses, higher borrowing costs for consumers, and more pressure on an economy already slowing in many areas. This does not mean a collapse is guaranteed, but it does mean the era of easy money is not coming back quietly. The system is being forced to confront reality instead of masking it with accounting assumptions. This is also where precious metals enter the conversation. Gold and silver are not just commodities, they are monetary assets that exist outside the banking system. They carry no counterparty risk, meaning they do not depend on a bank, government, or financial institution to remain valuable. Historically, when banking rules tighten and confidence becomes fragile, interest in hard assets increases. Not because people expect immediate chaos, but because they understand that rules can change overnight, and when they do, paper promises behave very differently than physical assets. None of this means panic is necessary. What it does mean is awareness is critical. The new banking rule is a signal, not a siren. It tells us regulators see risk that can no longer be ignored. It tells us the financial system is adjusting to a world of higher rates and heavier debt. and it tells us that the old assumptions about safety, liquidity, and stability are being rewritten in real time. The question is not whether this rule matters, but how prepared individuals and institutions are for what comes next. Because once the rule takes effect, the system begins operating under a different set of expectations, different pressures, and different constraints starting Monday. Banks wake up in a different operating reality, even if customers walking through the doors do not immediately notice anything unusual. The lights are on, the apps still work, ATMs still dispense cash, but behind the scenes, the rules governing risk, capital, and survival have shifted. This is how major financial changes usually happen, not with alarms and announcements, but quietly, through technical language that only accountants, regulators, and balance sheet managers fully understand. Yet these quiet changes often have the loudest long-term consequences, because they influence decisions banks make every single day about lending, investing, and protecting themselves. To grasp what this rule really changes, we need to talk about capital in plain terms. Capital is the cushion that absorbs losses. When things go wrong, think of it like the shock absorbers on a car. When the road is smooth, you barely notice them. When you hit a pothole at speed, they determine whether the car stays under control or loses it completely. For years, banks were allowed to treat certain assets, especially government bonds, as extremely smooth roads. Regulators assumed governments would always pay, markets would always remain liquid, and interest rate volatility would remain manageable. That assumption is no longer safe. Inflation proved stubborn, rates rose faster than expected, and the value of those bonds dropped. The road suddenly developed potholes, and the shock absorbers were not strong enough. The new banking rule essentially says banks must upgrade those shock absorbers. They need more high-quality capital relative to the risks they take. This does not mean banks are collapsing, but it does mean profits are pressured. When banks must hold more capital, they cannot deploy that money elsewhere. That reduces return on equity, a key metric investors watch closely. Lower returns often led banks to cut costs, tighten lending standards, or shift towards safer, lower-yield activities. Over time, this reshapes the entire financial landscape, often in ways that are invisible until they are already established.